Hi everyone, welcome back to the Value Investor Show. Today I want to talk through super investors. Super investors have been buying heavily these three stocks, which I'm gonna talk through today. But also I want to talk through why they have been buying over the last quarter and what has shifted that sentiment compared to the first quarter of 2025. So for today, I want to talk through the current market situation. Is the market becoming way too greedy? What does the greed versus fear index tell us? What are the top three stocks picked by super investors? Who is buying what? And what my intrinsic value is for the three stocks picked. Now, the S&P reached an all-time high. The market has been on a ramp. It has been climbing two fresh all-time highs last week, lifted by optimism that the Fed would cut rates as soon as September, and also optimism around a potential Russia-Ukraine peace deal. And while tech stocks helped push the index higher midweek, small caps stole the spotlight last week with their best run against the S&P 500 since April. Now, this week, the S&P 500 has been a little bit on the backdrop, has been dropping slightly, but overall, the market is still in an all-time high. Now, another thing that came out last week was the US PPI numbers, and they were much higher than expected. And this could mean that it could drive inflation. I'm going to explain why. So the PPI is essentially the producer price index. It's basically the wholesale price of goods. It shows how much the prices for the producers have increased year on year. And many times inflation lags PPI by 1 to 6 months. So this means that in the next 2, 3, 4 months, it is very likely that inflation will spike significantly, given that the increase in the producer prices will be passed on into the consumers for many companies. And my guess moving forward is that we'll probably see a tougher Fed, a tougher stance, and could potentially have more problems that could waterfall into the economy, into the disposable income of the consumer, into spending. So this is not an ideal scenario. And we're just now seeing some of the effects that potentially tariffs could have caused to the producers, to the consumers, in the prices, in the spending. And this is something that we have to be aware of. It doesn't change the fundamentals of businesses that I invest in, but it's something to have in the back of the head, that there could be that, the worst is yet to come. It could be that we see a worse off economy in the next 3 months. It could be that we see a better economy in the next 3-4 months. We don't really know. There's still a lot of uncertainty regardless of the all-time highs, and it's something to be alert. On the contrary, we're seeing a lot of companies spending like crazy, and most notably Meta, Microsoft, Amazon, and Alphabet. Since ChatGPT released, these companies have been increasing their spending, their capex, to stay ahead of the AI race. And in fact, Financial Times and the disclosures by companies suggest that these companies between now and 2029 will triple their spending. That global spending on data centers will almost reach 3 trillion by 2029. According to Morgan Stanley, in fact, they are suggesting that 1.4 trillion, so roughly 50% of that, will come from capital expenditure by big tech groups, but the other half will be required to come from investors, from developers, and that means that there's going to be more lending into the big firms, which means more debt, which means more investments with no real sign of high ROI, at least as of yet, because if you guys know, OpenAI, Perplexity, and these companies are largely driven by investments. They're yet to be profitable. Many of them are yet to be profitable. So the return of investment into these capex going into AI are yet to pay off. So there's a lot of hype, definitely, and I'm a strong believer of AI, but there hasn't been a tangible result of what that can bring to the companies yet. So they're essentially investing with no clear sign of what this could be in the future. But at least, our companies, the companies that I have invested in, are investing heavily to be at the forefront of what is the biggest shift in technology as we know it, which is artificial intelligence. But is the market way too greedy given the uncertainty that I've talked about, given that, inflation, the picture with inflation is not very clear yet? Before we dive into the rest of the video, I want to thank today's sponsor, Fiscal AI. If you're serious about investing, this platform is a game changer. It gives you beautiful, clear graphs with all the KPIs you care about in absolute numbers and percentage changes. It has powerful forecasting tools so that you can project performance and even calculate a company's intrinsic value value. It has industry benchmarks, so you know exactly how a business stacks up, and it has detailed equity research papers with everything you need. Above all that, it's all integrated with AI, so you can leverage AI in every part of your analysis. This is honestly a no-brainer platform. I use it every single day, and for a limited time, you can get 15% off using my link in the description and pinned comment below. Don't miss it, sign up now. Tariffs is not very clear yet, and still there's no peace deal, and there is still a lot of geopolitical tension in the world, even though it has been a bit muted over the last few weeks. And to be fair, my opinion is yes, the market is at an all-time high, but there is a reason behind it. Over 40% of companies this second quarter jacked up their earnings projections compared to 17% during the first quarter. As you guys remember, in the first quarter, there was a lot of uncertainty with tariffs. A lot of companies not only didn't jack up their earnings, but also dismissed their 2025 outlook completely, like companies like UNH, Deckers, and many others. But now, as they see that consumer sentiment is still quite strong regardless of everything that has been happening, and spending is quite strong, many of these companies have double beat earnings and have raised up their projections for this year, which is in my opinion very well justified that the stock market is where it is today, without saying that in a few months there could be a crash. This is still a scenario, this is still a probable scenario, but it really is something that I cannot control. No one can control. The only thing that I can control is where I put my money, depending on how well companies are performing. And in fact, some of the companies that I have invested in, for example, Deckers is a very easy example. It has been outperforming what they said they would deliver quarter over quarter. Companies are performing quite well. And I think this is what has led super investors to buy very heavily, because the last quarter, because after the April crash, we've seen super investors, and this is what the 13F filings have shown, that super investors have bought quite a lot. They have bought quite heavily, and they have bought some stocks in particular a lot more heavier than others, and that's United Health Group as the number one spot, led by Amazon, Alphabet, and others. For those that don't know, 13F filings don't only show how much the super investors own, but how much they buy and sell between a certain amount of time. And for the second quarter, which is what the 13F filings show, that's between the end of March or early April until the late June. So that's during the crash. That's when a lot of these companies were selling at the sale price, and it seems like most of these investors, regardless of all the uncertainty that was going on, and especially in April, everyone was saying this is the black swan event, you can see that super investors were actually buying. So this is something that doesn't go unnoticed, and this is a signal that many super investors still believe that these companies will outperform and will perform better regardless of the conditions. Warren Buffett, my favorite investor of all time, has added 1.6 billion worth of United Health Group stock in his portfolio. I've dove into this quite heavily in my latest video, and I would urge you to look at it. But he also added some other companies which I found quite interesting. He increased stakes in Constellation Brands, which shows that he's focusing also on defensive sectors that provide stability even during economic uncertainty. On the other hand, he has also made investments in home builders. Home builders have been impacted heavily by the higher interest rates, by the higher inflation, and a lot of those home builders are suffering. They're suffering, they have loads of debts to pay, and especially in the US, these home builders haven't been building as much as they have used to in the last 5 years. And the fact that Warren Buffett has made this investment suggests that he has optimism about cyclical sectors that are tied to economic growth, such as housing, such as infrastructure. So perhaps Warren Buffett is seeing that interest rates could be lower and housing could turn around over the next few years. Remember that Warren Buffett only invests in stocks that he plans to hold for a lifetime. So in fact, he has seen some gap, he has seen some prices sell off at levels that were very attractive for him, like United Health, and he's seen an opportunity to enter the home builders sector as well for the very long-term future. He also reduced some of his Apple shares, which we have seen over the last quarters, so that wasn't a surprise. Bank of America as well, he has been reducing his exposure over the last few quarters, and he also sold some of his telecoms stocks as well. So overall, nothing surprising on the sells, but rather on the buys. Michael Berry as well added United United Health Group. And another notable buy that I wanted to flag is Lululemon. Lululemon is quite a beaten down stock. It's very surprising that Michael Berry added Lululemon because there is one other stock that I commonly spoke about, which is Deckers Corporation, which very much suffered like Lululemon. But the difference for me between Deckers and Lululemon is that Deckers is still growing at 20% growth year on year, while Lululemon has seen some stagnation in its brand. I do think that Lululemon is way more risky and prone to consumer trends rather than Deckers, because Deckers has two brands or multiple brands, but the two main brands are Hoka and UGG. And it's quite surprising that Michael Berry added Lululemon in the sense that he is seeing some gap in consumer goods, and consumer goods athletic companies have been trading at a discount, not only Lululemon and Deckers, but also Nike, for example. So it does show that he's also a bit bullish on this sector, which I also found very, very interesting. Now, David Tepper as well bought UNH, making it his second largest holding at 12% of his portfolio. That's an insane buy. And for those that don't know, David Tepper is known for bold, opportunistic moves. And it appears that he is very, very confident in United Health Group. He added 1,300% into his position to take UNH to his second biggest holding. Notably, he also bought Nvidia, Amazon, TSM, which shows a bullish behavior into AI, into the AI value chain, as well as the data center industry with buys in Amazon, but also has sold Meta and a lot of his Chinese investments. Michael Berry also sold some or most of his Chinese positions, and I think this primarily came after the April tariffs and the bigger trade war with China, which makes sense as these guys are trying to limit their exposure to China, especially with Trump and Xi Jinping yet to meet, yet to come to a formal arrangement and show that they're still willing to cooperate. I think with the whole China-US divide, they're trying to be less risky and less prone to tariffs against China. Bill Ackman, another very notable investor, bought Amazon heavily and added more Google. Bill Ackman made a 10% position of his portfolio, signaling strong conviction into Amazon's long-term growth prospects. And I think this move suggests that despite recent market volatility, some of the smartest investors see Amazon as a core holding, as a core company in the future in the AI world. And my guess is that he probably bought Amazon post tariffs at roughly $165 to $170 a share, which makes it that he's probably up 35% or so on his Amazon stock. I also bought and hold some of these companies, and I've bought Amazon a few years ago. I also improved my position, added more to my position after the April tariffs, after that crash. I've recently entered Alphabet again in April. I'm up 30% on Alphabet, 62% or 63% on Amazon, and I've been buying United Health Group this year at an average price of $281, and I'm already up 8% roughly. Can you guess the rest of my full portfolio? I will reveal my full portfolio at 10,000 subs, so if you could subscribe, it would mean a lot. Now, let's jump into the intrinsic values. For me, United Health Group is an undervalued stock still, even at this price point. I have included in my analysis the 2025 impact. Many of you guys that watch my videos quite heavily know that I have shown this slide a lot. But in my base case scenario, I do expect the price target of United Health to reach 500 to 700 USD by 2030. I do think that in my base, which is very conservative, the company is subject to grow at 10 to 11% in terms of revenue, EPS, and free cash flow, and with a margin of safety of 50% and a discount rate of 10%. My average intrinsic value for this company is $205. So it's still way undervalued, but with a lower margin of safety as is at the 300 level. On the other hand, we have Amazon and Google, which are both cash cows of companies. They have been increasing revenue year on year, quarter on quarter. And as you guys see, let's take Amazon, for example, which is roughly double the size of Google in terms of revenue. They have been a cash cow. They have been a machine in printing money. During 2022, they had a point where their money margins declined heavily, and that's around the time when I started buying Amazon. And since then, they have managed to increase their net margin quite significantly. On the contrary, Google has also seen a dive into their net margin between 2022 and 2023. However, they were still at very high and healthy net margin levels, but since then their net income margin has been increasing rapidly and reaching 31%, which is just whopping. My expectation is that, or kind of my guess is that we could see another drop into the future in net income, just because there are a lot more R&D expenses with these companies, a lot more spending in AI, so net income could decrease, and it could provide another opportunity to enter these stocks. But with that being said, fundamentally these two businesses are just amazing businesses. From a free cash flow perspective, they're both very strong. In fact, Google is much more stronger in free cash flow just because Amazon is much more capital intensive than Google. But Amazon, the good thing with Amazon and why I think is valued at a much higher level is because it's a very well diversified business. They have AWS, which is growing at crazy levels, and many suggest that AWS is probably one of the strongest, if not the strongest, data center and web services company, because AWS could essentially be its own company. But they also have Amazon.com. They're now expanding into grocery. Whereas if we look at Google, most of Google's revenue, in fact 80% of Google's revenue, comes from ad revenue. It comes from YouTube, it comes from search advertising, and there has been a lot of talks about Google being replaced by ChatGPT and others as people use it more and more frequently, and search is not growing as much. But I do think that this is false. I do think that search is still growing, and I do think that Gemini is way stronger than ChatGPT 5.0. And so now I think that there is a sentiment that is shifting for Google as well, that AI isn't really a threat to Google, but it is rather making Google an even stronger player. But overall, both businesses are extremely strong businesses. Thank you for watching. Let me know on what stock you would like to see next. Please like, please subscribe, please comment. It means a lot to me. And thank you so much, and I'll see you at the next video.